Hi, and welcome to my monthly market insights video. My name is Dan Timitich. I'm a portfolio manager at T2 Asset Management. Before we get started, this video is for educational purposes only. Opinions expressed in this video are mine and do not reflect the opinions of other managers. You should always consult with a financial advisor before making any investment decisions. Investments involve risk and are not guaranteed. Okay, so after a strong June, it looks like the summer months continue to push the market higher. All of the major market averages posted positive returns in July, led by the tech-heavy NASDAQ, and then followed closely behind it is the S&P 500. The one market that is rarely talked about in the news is the high-yield bond market. While everyone is fixated on the stock market, the high-yield bond market ended up nearly matching the S&P 500 return and outperformed both the Dow Jones Industrial Average as well as the small-cap market, giving investors a return of nearly 5.5% for the month of July. As we look at this chart of the S&P 500, you can see that we're flirting with the all-time highs that we saw back in February. And as you can see, you would think that everything was great and we were completely out of the woods from this pandemic. Well, I just wanted to be clear. The S&P 500 is made up of 11 sectors, and not all of these sectors have behaved the same way. So let's take a look and see what these sectors look like. Here we have each of the S&P 500 sectors. As you can see, the entire market is basically being held up by three sectors: consumer discretionary, communication services, and technology. These three sectors represent about 46% of the S&P 500. Yes, healthcare finally turned positive for the year, but let's not make any mistake about it. Technology is what's driving the performance of the overall market. Now, I'm often asked if the market is getting ahead of itself, and I do believe that the market has pulled forward a lot of growth in earnings, especially in technology. But one way we can determine whether we have a high level of complacency in the market is by looking at this chart here. The CBOE put-call ratio is an indicator that shows put volume relative to call volume. Put options are used to bet on a decline in the market, and call options are used to bet on a higher market. As you can see here, this indicator is at the second highest level in 2 years. Whenever the market gets overly bullish, there's a real risk of a market correction. For example, back in November 2019, we saw similar bullishness right before the huge sell-off in December of 2019. What I'm really just trying to demonstrate here is that investors are typically rewarded when they buy the market at its most bearish and selling it when it's at its most bullish. Now, obviously, this is only one indicator, but an important indication of complacency in the market. So let's take a look at just another factor. Here we have a chart showing the S&P 500 on the top and the corresponding volume of the market at the bottom. As you can see, the volume in March was huge as investors did everything they could to sell stocks. As volume continued to fall, the market rallied. So the question is why? Well, with lighter volume, any stock purchases exaggerate the move in the market to the upside. When the market volume is light, as we've seen recently, there are typically less sellers, so you see a one-way kind of push, whether it's up or down, but in this particular case, it was to the higher side. It'll be interesting to see what happens when the volume gets back to more reasonable, more normal kind of levels. My worry is that this volume is from the new era of day traders as they put their stimulus money into the market, and it's going to be interesting to see what happens when the market takes a pause or pulls back. What do these day traders end up doing? Are they going to try to catch a falling knife, or is it going to provide some sort of support for the market? All that's to be determined. At this point, we can look at all sorts of indicators, earnings, valuations, etc. None of that really matters in the here and now. The huge rally from the March lows is attributable to the Fed printing money and providing unbelievable amounts of liquidity. In the last recession, the Fed's balance sheet went from $900 billion to over $2 trillion. By 2016, or 7 years later, the balance sheet grew to over $4 trillion. In the first half of 2020, the Fed's balance sheet went from just over $4 trillion to $7.2 trillion. It nearly doubled in just short 6 months. So why does this all matter? It matters because the Fed is forcing investors to buy risky assets by keeping rates at zero. Think about retirees and those living on investment income. If your fixed income assets are not providing enough income, you're going to look for alternatives. Right now, the alternative is stocks. The risk is that once the Fed stops printing money, the stock market's going to fall, and investors, especially these crossover investors, are going to see real losses. The Fed keeps claiming that it wants to allow the market to function normally. That's what we heard from the chairman a number of times. There's nothing normal about the Fed printing money, so much money, and artificially inflating financial assets. There's nothing normal about the Fed buying corporate bonds to help support the bond market. But, they're not the only game in town. Monetary policy is just one of the two policies in place. And so let's take a look at the fiscal side. Here we have a chart of the total debt that's outstanding in the United States. This is what we call the fiscal side. As you can see, the total debt at the beginning of 2008 was just over $9 trillion. And as you can see, we have been quite responsible over the last 12 years in managing our spending. You could insert the sarcasm here. The total outstanding debt went from $9 trillion to over $23 trillion. Just for perspective, the total GDP of the United States, the total of all goods and services produced in the United States at the end of 2019 was $21 trillion. Our debt has grown so much that the credit rating of the United States was downgraded back in 2011, and Fitch just recently revised the outlook for the U.S. from stable to negative. By now, you should know that the entire S&P is being held up by just a handful of stocks. I think that's been all over the news. And we hear all the time how companies are beating earnings estimates. Well, if earnings estimates are, let's say, minus $10 and the company reports a loss of only $9, of course they beat estimates. It doesn't mean that the numbers were great. It just means that they beat their estimates that were very, very bad. So let's take a look at four companies that just reported earnings: Apple, Amazon, Alphabet, and Facebook. Alphabet's the parent of Google. When you compare this last quarter's earnings to a year ago, you can see that Apple's earnings are up about 18%, but their stock price was up nearly 90%. Amazon's earnings nearly doubled from a year ago, so that was great, and its stock price has been rewarded. It's up 60%. Alphabet and Facebook saw earnings declines from a year ago, and yet their stocks are both up over 20%. With the exception of Amazon, I would consider these year-over-year earnings numbers to be less than impressive. Remember, the environment that these companies operate in was ideal during this pandemic, as everybody was shifting to additional technologies in order to live. So let's take a look at what we're basically paying for these companies now versus in the past. While we all agree that that tech is the only area of growth, how much you pay for these stocks, it matters. At the end of 2019, you could buy Apple for about 18 times earnings. Now it's over 30 times earnings. Amazon was 80 times earnings. Now it's over 120 times earnings. Alphabet, Google was 27 times. Now it's 33 times. And Facebook is really the only major company where its valuation is about the same as it was last year. My point here is that if you're paying such an outrageous multiple for these stocks, you're pricing in absolute perfection for many, many years out. I'm not saying that these aren't great companies. I'm saying that these great companies are too expensive. And with so much of the market dependent on these stocks, if you see any sort of chink in their armor, look out. The rest of the companies in the S&P 500 just simply cannot offset these mammoth companies. For example, if the stock price of Microsoft falls 1%, JP Morgan's stock would need to go up 5% just to offset the impact of Microsoft alone on the index. Another example, if Apple falls 1%, Home Depot's price would need to rise about 5% to offset that. Why? The S&P 500 is simply a market cap weighted index. So the bigger the company, the bigger the weight it's given. So imagine what would happen if the top 5 companies that represent about 20% of the index fall 5 to 10%. Can the other companies carry us higher? I certainly don't think so. So let's take a look at some of the changes I made in my core equity portfolio, given all the things that have gone on. We started the month with about 40% in cash, 35% in stocks, and 25% in alternatives. During the month, I reduced, by mid-month, I reduced some stock exposure and moved it to cash, and therefore I was holding closer to about half the portfolio in cash. And then by the end of July, I did use some of that cash to add about 30% exposure to short-term corporate bonds and senior bank loans. I did end up maintaining the same level of exposure to alternatives at 25%, and I held my stock exposure also at 25%, which was primarily in tech stocks. So to wrap up, the market is looking quite fragile to me. Volume is very light, complacency is high, and the market is too dependent on just a handful of stocks. I think investors are benefiting from holding alternatives that provide equity-like returns without all of the volatility. I think the big question in August is going to be what happens to when the PPP loans are forgiven. My fear is that you're going to see a new wave of unemployment. That's still to be determined depending on what kind of progress is made in Congress. I still believe that there's going to be rolling shutdowns around the country as coronavirus cases increase and pressure mounts on some of these governors. That's all going to have a negative impact to our economy in the coming months. And then while the Fed keeps saying that it's going to do whatever it takes to keep liquidity in the market, there is only so much they could do beyond inflating financial assets. And then finally, too many people have extremely high hopes on really big stimulus packages coming from Washington. At this point, people are expecting a few $1 trillion every couple of months, it seems. I'm concerned that Washington is, once again, probably going to disappoint the market in the size and scope of the next package. But again, we're going to see. It's tough because this is an election year, so it's anybody's guess as to what's going to happen coming out of Congress. As always, I appreciate you watching. If you have any questions or you want more information, just send me an email or give me a call. We appreciate the time you took to watch this video, and I'll be back again next month. Until then, I hope you guys all stay safe and take care.